On August 28, 2026, MSX Research published an analysis. Nvidia answers on earnings. Warsh decides on valuations. How does Jackson Hole impact U.S. stocks? At the center of the story are two forces moving markets in very different ways: Nvidia's earnings and Federal Reserve Chair Kevin Warsh's monetary policy signals. Here's why that matters to every investor. Let's start with Nvidia. Nvidia just reported fiscal second quarter revenue of $96.2 billion, up 106% from a year earlier. Even more important, its data center business generated about $89 billion, up 117% year over year. That tells investors something important. Demand for AI infrastructure is still extremely strong, but here's where the story gets interesting. Strong earnings don't automatically mean a stock should keep going higher, because investors don't only ask, how much money will a company make? They also ask, what should I pay today for those future earnings? And that's where interest rates come in. At the July FOMC meeting, the Federal Reserve kept its policy rate at 3.50 to 3.75%, but the vote was 9-3. Three policymakers wanted a 25 basis point increase. But the bigger issue for growth stocks may not be the overnight Fed rate. It's the long end of the Treasury market. The 10-year Treasury yield recently approached 4.75%, while the 30-year yield reached around 5.34%. Why does that matter? Because higher long-term yields increase the discount rate investors use when valuing future cash flows. That can put pressure on companies whose valuations depend heavily on profits expected years into the future. And there's another piece of this puzzle. AI companies aren't just competing for customers. They're competing for capital. Reuters reported that Amazon, Alphabet, Meta, and Oracle had issued about $194 billion of bonds in 2026 through early July, as the AI infrastructure build-out accelerated. When governments borrow heavily, while technology companies are also raising enormous amounts of capital, investors have more places to put their money. That competition can keep long-term borrowing costs elevated. The U.S. Treasury has also stepped into the bond market. It announced that certain long-term Treasury buyback operations would increase from a maximum of $2 billion to at least $4 billion per operation. But here's the lesson. $4 billion sounds enormous. Compared with a Treasury market measured in tens of trillions of dollars, it's relatively small. So this may improve liquidity and reduce some short-term pressure. But it doesn't magically eliminate the underlying problem of government borrowing, debt supply, inflation, and demand for capital. Here's the part I want investors to remember. Don't look at earnings in isolation. Look at earnings and the price you're paying for those earnings. Imagine two companies generating the exact same future cash flow. If interest rates are low, investors may be willing to pay a higher valuation. If long-term rates rise significantly, those same future cash flows become less valuable today. That's why a great company can report great earnings and still experience pressure in its stock price. Fundamentals matter, but valuations matter too. So what should investors watch now? First, Nvidia's ability to keep growing AI-related revenue. Second, long-term Treasury yields. Third, inflation. Fourth, Federal Reserve policy. And fifth, whether AI companies can generate enough cash flow to justify the enormous amount of capital they're deploying. The biggest lesson isn't whether Nvidia is bullish or bearish. It's understanding the relationship between earnings and valuations. Nvidia can determine how much profit the AI economy is generating. But interest rates can influence how much investors are willing to pay for those profits. That's the difference between a good company and a good investment at the right price. Follow the commission desk, because understanding the market is more powerful than simply reacting to it.